Hi everyone, today we'll be going over accounts, October-November 2020, paper 3-1, question number 6. This is structured paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 6 is part of section B, which deals with costs and management accounting. Now, without any further delay, let's get started. Samir has a business in the leisure industry. He is purchasing a boat and plans to start luxury river cruises. In his original plan, which had a positive net present value, he anticipated the following revenue. So for year 1, the number of tickets sold would be 8,000, and for year 2, the number of tickets sold would be 8,300, whereas the price per ticket for year 1 would be 100, and for year 2, it would be 110. Alright, now he is considering a revised plan, employing local historians to accompany the cruises and give lectures on the history of the area. And he thinks that this will result in 20% more tickets being sold each year. So this will be our original plan. Now we'll figure out our revised plan. So this is the number of tickets, and this is the price per ticket, and we have year 1 and year 2. So what we know is that 20% more tickets will be sold each year. So if previously the tickets sold for year 1 was 8,000, then this would increase by 20% for our revised plan. Let's do that. So that's just going to be 8,000 times 1 plus increment of 20%, which we can write down as 0.20. So the number of tickets for year 1 under the revised plan will be 8,000 times 1 plus 0.20, which results in the value of 9,600. Okay, so that would be 9,600. Now let's figure it out for year 2. Again, we have to increase this ticket number of 8,300 by 20%. So that's just going to be 8,300 times 1 plus 20%, which we can write down as 0.20. And this gives our number of tickets sold on year 2 under the revised plan to be 8,300 times 1 plus 0.20, which results in the value of 9,960. So this is the ticket sold in year 2 under our revised plan. Let's write it down. Okay, then we are also told that the selling price of the tickets would be $10 higher than under the original plan. So if for year 1 the price is 100, then this would increase by 10. So that's just going to be 100 plus 10, which results in the value of 110, right? This is the price for first year. Now for second year, previously it was 110, so now we need to increase it by 10. That's going to be 110 plus 10, which results in the value of 120. That's the price for second year under our revised plan. Okay, now we can move towards the first part of this question. We need to calculate the total revenue for each year for the original plan as well as the revised plan. Okay, so the total revenue is just going to be the product of the number of tickets sold per year and the price per ticket. So let's figure it out for our original plan. For year 1, we have the number of tickets of 8,000 and the price per ticket of 100. So that's going to be 8,000 times 100, which gives the total revenue under original plan for year 1 to be 800,000. Now we figure the same for year 2. We have the number of tickets sold per year to be 8,300 and the price per ticket is 110. So let's multiply these together. Now this gives the total revenue under the original plan for year 2 to be 913,000. Let's write these values down for the original plan. Okay, so we have year 1 and year 2, and this is the revenue. And for year 1, we figured it out to be 800,000, and for year 2, we figured it out to be 913,000. Now let's repeat the same process for our revised plan. Okay, for the revised plan for year 1, we have our number of tickets sold per year of 9,600 and the price per ticket was 110. So let's multiply these two together. That's 9,600 times 110, and this gives our total revenue under revised plan for year 1 to be 1,056,000. Now let's repeat the same process for year 2. We have our number of tickets sold per year of 9,960 and the price per ticket is 120. Let's multiply these two together. Now this gives the total revenue under revised plan for year 2 to be 1,195,200. Now let's write these two values under our revised plan. So this is for year 1 and year 2. And we're talking about revenue. We figured it out to be 1,056,000 for year 1. And for year 2, it was 1,195,200. Okay, so this concludes the first part of this question. Now we can move towards the second one. We're told that the majority of the running costs of the cruises will be fixed, and the variable costs are expected to amount to $30 for each ticket sold. Now we need to figure out the total variable cost for each year. So the total variable cost per each year would just be the number of tickets sold times our variable cost per unit. And we already know that the variable cost per unit is 30, and we have our number of tickets sold for original plan as well as revised plan in the above information. Let's have a look. So we can just multiply these together. Under original plan in year 1, we have our number of tickets sold of 8,000. So that's going to be 8,000 times the variable cost per unit, which is 30, which gives the total variable cost under original plan for year 1 to be 240,000. Let's repeat the same process for year 2. We can see that the number of tickets sold per year is 8,300. So that's 8,300 times the variable cost per unit, which is 30, which gives the total variable cost under original plan for year 2 to be 249,000. Now let's write these values down for our original plan. We have year 1 and year 2. And we're talking about the variable cost. For year 1, we figured it out to be 240,000. And for year 2, it was 249,000. Now we repeat the same process for revised plan. Let's have a look above. We can see that under the revised plan, the number of tickets sold per year for year 1 is 9,600. So that's 9,600 times the variable cost per unit of 30, which results in the total variable cost under revised plan for year 1 to be 288,000. Now we repeat the same process for year 2. We can see that the number of tickets sold per year is 9,960 times the variable cost per unit, which is 30. And this gives the total variable cost under revised plan for year 2 to be 298,800. Now let's write these two values for our revised plan. So that's for year 1 and year 2. We're talking about variable cost. And for year 1, we figured it out to be 288,000. And for year 2, we figured it out to be 298,800. Alright, this concludes the second part of this question. Now we can move towards the third one. We are again given additional information. First of all, let's have a look at our third question. We need to calculate the increase in net present value which would arise if the revised plan was used instead of the original. Okay, so let's have a look at our additional information. The cost of employing the historians will add 125,000 per annum to the total fixed costs. Okay, so if we're talking about original costs, we are not given any fixed costs, so the fixed cost only exists for our revised plan. Then the capacity of the boat restricts the total number of tickets which can be sold each year to 10,000, and this won't be a problem because we know that even under the revised plan, the number of tickets sold each year does not cross 10,000. Let's have a look above. We can see that it is 9,600 and 9,960, which is less than 10,000. So we do not have to worry about the second information. Then for the third information, we are given that Samir uses a cost of capital of 10% per annum. So this will be the interest rate at which we will apply our discount rate. Then the discount factors for this rate are as follows. For year 1, it is 0.901, and for year 2, it is 0.826. Now this is a very simple question. We can easily figure out the increase in net present value. So in order to do so, let's start with our year. We have year 1 and year 2. Okay, then we can start with our increment in revenue, right? So this is increase in revenue. Then we also have variable costs. So we can write down our increase in variable cost. And then we also have our fixed costs given for the revised plan. So we can term it as increase in fixed costs. Okay, then we need to add all these 3 columns and then figure out our net cash flow or increase in net cash flow. Okay, then we need to multiply our net cash flow with the discount factor, which is at 10%. All right, then we can finally figure out the increase in net present value. So that's our net present value. Okay, we will start with our increase in revenue, and we know that we already figured out our total revenue for both the original plan as well as the revised plan in the first part of this question. So let's have a look there. Okay, so we're just talking about the increment from the original plan to the revised plan. And we can see that for year 1, original plan had the value of 800,000, whereas the revised plan had the value of 1,056,000. So there is definitely an increment in the revised plan, right? So we need to figure out that increment value, which is just going to be the difference between these two values. Let's figure it out. So that's 1,056,000 minus 800,000, which results in the value of 256,000. So this is the increment for the first year. Now we repeat the same process for the second year. So that will be the difference between these two values. That's 1,195,200 for the revised plan minus 913,000 for our original plan, which gives our increment in revenue for year 2 to be 282,200. So let's write these two values in our statement to figure out the increment in net present value. For year 1, the increment in revenue was 256,000, and for year 2 it was 282,200. Now we're talking about variable costs, which is again given in the second part of this question. We already calculated it. So we can definitely see that the variable cost is higher for the revised plan for both of the years, right? And we just repeat the same process like we did for the revenue. So we're just talking about the increment factor, which is going to be the difference between these two values. So for year 1, we have the variable cost of 288,000 for the revised plan minus 240,000 for original plan, which gives our increment in variable cost for year 1 to be 48,000. Now we repeat the same process for year 2. That's 298,800 for the revised plan minus 249,000 for the original plan, which gives the increment in variable cost for the second year to be 49,800. Okay, let's substitute these two values into our statement in order to figure out the increment in net present value. So that was 48,000 for year 1 and 49,800 for year 2. Okay, now we need to figure out the increment in fixed costs. And like I said before, there were no fixed costs for the original plan. So the entire fixed cost given for our revised plan would be the increment value, right? And we are told that the cost of employing the historians will add 125,000 per annum to the total fixed cost. So this will act as the increment for both the years. Let's write this value down. That's 125,000 and 125,000. Okay, so in order to figure out the net cash flows, we always subtracted our cash outflows from the cash inflows, right? So this is cash inflow minus cash outflow. And we can definitely say that revenue is our income, which means that this can be classified as cash inflow, but variable costs and fixed costs are the expenses, right? So these we need to pay it. So that's cash outflows. Now, in order to figure out the net cash flows, that's going to be increase in revenue minus increase in variable cost minus increase in fixed cost. So if you find it easier, then you can also put these values in a bracket so that you do not forget to subtract these values in order to figure out the net cash flow. So for year 1, the net cash flow is going to be 256,000 minus 48,000 minus 125,000, which results in the value of 83,000. And for year 2, that's 282,200 minus 49,800 minus 125,000, which results in the value of 107,400. Okay, now we need the discount factors, which is given in our additional information. For year 1, it was 0.909. And for year 2, it was 0.826. Now, in order to figure out the net present value, we just multiply our net cash flow and the discount factor. For year 1, that's going to be 83,000 times 0.909, which results in the value of 75,447. And for year 2, that's going to be 107,400 times 0.826, which results in the value of 88,712.4. So for the ease of our calculation, we can just round it off. That's going to be 88,712. Now we can easily figure out our increment in net present value. That is just going to be the sum of these two values, right? Since we are talking about increment for all of these, and this is actually also the increment in net cash flow. So this will be our increase in net present value. So let's add these two values. That's going to be 75,447 plus 88,712, which results in the value of 164,159. And this concludes the third part of this question. Now we can move towards the fourth one. We now need to calculate the total number of tickets Samir would have to sell in year 1 under the revised plan so that the increase in revenue equaled the additional fixed costs. And since we're talking about only year 1, the increase in our additional fixed costs would just be that of 125,000, right? Let's write it down. So increase in fixed costs is 125,000. And what we now require is that the increase in revenue should be equal to this value. Okay, let's write it down in an equation. So increase in revenue should be 125,000. And from this particular equation, we now need to figure out the number of tickets Samir would sell in year 1 under the revised plan, right? So let that variable be y. So y is going to be the number of tickets sold under revised plan for year 1. Okay, so the increase in revenue would just be the total revenue for the revised plan in year 1, right? So that would be the number of tickets sold, which is y, times the price per ticket for year 1 under our revised plan. So let's have a look above. We figured out our price to be 110. So let's multiply it. That's y times 110 minus our revenue for year 1 under the original plan, which we already figured out in the first part. We can see that the revenue on the original plan is 800,000. Let's write it down. So that's 800,000 equals to 125,000. Now this is a very simple equation. We just need to figure out the value for y. That's going to be y times 110 equals to 125,000 plus 800,000. So this is just going to be y equals to 125,000 plus 800,000 divided by 110, which gives our number of tickets Samir would have to sell in year 1 under the revised plan so that the increase in revenue equal the additional fixed cost to be 125,000 plus 800,000 divided by 110, which results in the value of 8,409.09. And since we're talking about the number of tickets, we cannot put it in a decimal value, so we need to round it off. So this goes to 8,410. So this will be the number of tickets we need to sell in order for the increase in revenue to be equal to the additional fixed cost of 125,000. This concludes the fourth part of this question. Now we can move towards the fifth one. We need to assess any concerns Samir might have about the revised plan. So the first one would definitely be the increment in fixed cost, right? And increment in fixed cost always increases the risk. Let's write it down. It would increase the risk as it involves a substantial increase in the fixed costs. And this fixed cost does not really guarantee that the extra revenue will happen, because we are just estimating it, or estimating our revenues and the number of tickets sold for each of the year 1 and year 2, right? Let's write it down as well. With no guarantee that the extra revenue will happen. Okay, so this concludes our fifth part of this question. Now we can move towards the sixth one. We need to advise whether or not he should implement the revised plan. Okay, the first one is that we were told that the net present value for our original plan had a positive value. Let's have a look above. Yeah, right here. We are told that in his original plan, which had a positive net present value. And we also figured out that for our revised plan, there is obviously an increment in net present value. So if there was an already positive value and then again there is an increment, then that obviously results in a positive value as well, right? So what we can say that it increases an already positive net present value, right? So let's write it down. It increases an already positive net present value, but we cannot make a decision based on only the net present value, right? He also needs to consider other methods of appraisal. Let's write it down. He needs to consider other methods of appraisal. Then we can also say that it increases the risk of the plan as it has an additional fixed cost. So it increases the risk of the plan. And finally, we also know that this entire numbers are based on estimates, so we do not know whether in reality these numbers will hold up. So it is based on estimates. Now we need to make a decision. So based on the fact that this definitely increases the risk of the plan and that the numbers are based on estimates and we do not know whether in reality it will hold up or not, I would advise Samir that he should not implement the revised plan. So let's write the decision clearly. Samir should not implement the revised plan. This concludes the sixth part of this question. Now we can move towards the seventh one. We need to explain how sensitivity analysis helps in investment appraisal. So sensitivity analysis definitely deals with forecast figures to measure the effect of an outcome of a change in a variable cost or income, right? Let's write it down. It deals with forecast figures to measure the effect on an outcome of a change in variable cost or income. And this is definitely useful when projects last for a number of years. Let's write it down as well. It is useful when a project lasts for a number of years. Alright, this concludes the 7th part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.